The robotics industry is on the verge of a multi-trillion-dollar explosion. This is the next big technological revolution. We're talking about opportunities that could dwarf the internet boom, with life-changing returns for early investors. In this video, I'll break down 3 robotics stocks with massive upside. One powering the eyes of self-driving cars, another revolutionizing delivery, and a third transforming medical recovery. These aren't random picks, they're leaders in their niches, each with the potential to be a 10-bagger or more. So buckle up, smash that like button, and subscribe for more deep dives into high-growth stocks. Let's get right into the first stock. 𝗗𝗦𝗗𝗘 Robotics is up first. 𝗗𝗦𝗗𝗘 Robotics, ticker ARBE, is redefining how autonomous vehicles see the world. In a landscape where perception is everything, 𝗗𝗦𝗗𝗘 is pushing the boundaries of what's possible, giving machines a new way to interpret their surroundings with unprecedented clarity and reliability. Their 4-dimensional imaging radar is a leap beyond cameras and LiDAR, delivering high-resolution all-weather vision for self-driving cars. While cameras can be blinded by darkness or glare, and LiDAR can struggle in rain or fog, 𝗗𝗦𝗗𝗘's radar cuts through the noise, providing a clear, detailed picture no matter the conditions. This technology is designed to work seamlessly in the real world, where weather and lighting are unpredictable. Unlike traditional radar, 𝗗𝗦𝗗𝗘's tech adds azimuth and elevation, creating a detailed 3D map that distinguishes between pedestrians, cyclists, and vehicles, even in tough conditions. This means a self-driving car can spot a child darting into the street at night, or a cyclist in heavy rain, and react instantly. The system's ability to track hundreds of objects simultaneously, with pinpoint accuracy, is a game-changer for safety and reliability. By capturing both the horizontal and vertical position of every object, 𝗗𝗦𝗗𝗘's radar creates a living, breathing map of the environment in real time. This level of perception is what separates basic driver assistance from true autonomy. This is the kind of perception needed for true level 4 and 5 autonomy. At these levels, vehicles must handle complex scenarios, urban streets, highways, and everything in between without any human input. 𝗗𝗦𝗗𝗘's radar is designed to be the backbone of this new era, enabling cars to make split-second decisions with confidence. The ADAS market is booming, and every major automaker is racing to integrate safer, smarter sensors. Advanced driver assistance systems are no longer a luxury. They're becoming a standard feature, and the demand for reliable, high-performance sensors is skyrocketing. This is a multi-billion-dollar opportunity, and 𝗗𝗦𝗗𝗘𝗏 is positioning itself right at the center. 𝗗𝗏𝗗𝗃's already landed partnerships with Tier 1 suppliers like 𝗣𝗟𝗓, giving them a direct pipeline into millions of vehicles. These collaborations are crucial, as Tier 1s are the gatekeepers to the world's biggest automakers. With these relationships, 𝗗𝗏𝗗𝗃's technology can scale rapidly, reaching global markets faster than competitors. The scale is enormous. Even a small slice of the global car market could mean billions in revenue. With over 70 million vehicles produced annually, the potential for 𝗗𝗦𝗗𝗘𝗏 to capture value is staggering. As automakers transition to next-generation sensors, 𝗗𝗗𝗗𝗃 stands to benefit from every new model that rolls off the line. While the stock is still under the radar, this is a classic picks and shovels play, supplying the tech that powers the entire industry. Instead of betting on which car company will win the race to autonomy, you're investing in the essential technology that every player needs. It's a strategy that's built fortunes in past tech revolutions. 𝗗𝗦𝗗𝗃's radar isn't just for cars. Think trucking, delivery drones, industrial robots, any machine that needs to navigate safely. The applications are nearly limitless. From autonomous freight on highways to last-mile delivery robots weaving through city streets, 𝗗𝗏𝗗𝗃's technology could become the standard for any machine that moves through the world. Financially, 𝗗𝗏𝗗𝗃 is early stage and burning cash, but their backlog and design wins show real momentum. The company is investing heavily in R&D and scaling up production, betting that their technology will become indispensable as the market matures. For investors, this means volatility in the short term, but potentially massive rewards if 𝗗𝗏𝗗𝗃's vision plays out. The current market volatility has pushed the stock down, making it an attractive long-term bet if you believe in autonomous tech. For those with patience and conviction, these dips can be opportunities to build a position before the broader market catches on. 𝗗𝗏𝗗𝗃 claims their radar offers 100x the resolution of competitors, a potential game-changer if they scale successfully. This leap in performance could set a new benchmark for the industry, forcing others to play catch-up or risk being left behind. Once automakers see this level of detail, it could become the new industry standard. The ability to detect and classify objects with such precision is what will ultimately make autonomous vehicles safer than human drivers. Yes, competition is fierce, but 𝗗𝗏𝗗𝗃's tech moat is real. Their proprietary algorithms, custom silicon, and years of radar expertise give them a significant edge. As the industry matures, these advantages could become even more pronounced, making it difficult for new entrants to catch up. 𝗗𝗏𝗗𝗃 Robotics comes in as a small-cap player at roughly $239.6 million in market value, still deep in investment mode with earnings per share at $0.53. The company reported just $768,000 in revenue for 2024 and a net loss of $49.31 million, underscoring a business still building toward scale. This is a high-risk, high-reward play, volatile now, but with explosive upside if they become the go-to solution. The journey won't be smooth, but for those willing to stomach the bumps, the payoff could be transformative. Do your own research, but the thesis is simple. Self-driving cars need to be safe, and 𝗗𝗦𝗗𝗗𝗘 provides the critical eyes. Without this level of perception, true autonomy simply isn't possible. Their management team is stacked with radar and automotive experts, giving them the know-how to execute. Leadership matters, especially in a field as complex and fast-moving as autonomous tech, and 𝗗𝗦𝗗𝗗𝗘's team brings decades of experience to the table. In summary, massive market, disruptive tech, key partnerships, and a stock price that could be a bargain for patient investors. 𝗗𝗦𝗗𝗗𝗘 is at the intersection of several megatrends: autonomy, safety, and the digital transformation of transportation. Watch for new design wins and production milestones. Each one is a step toward dominance. As more automakers adopt 𝗗𝗦𝗗𝗗𝗘's radar, the company's influence and market share will only grow. 𝗗𝗦𝗗𝗗𝗘 Robotics is just getting started. The road ahead is long, but the foundation is strong, and the potential is enormous. Now, let's talk about the future of delivery. 𝗟𝗡 Robotics, ticker SERV, is transforming last-mile delivery with autonomous sidewalk robots. These compact, electric-powered machines are designed to navigate city streets and sidewalks, bringing a new level of efficiency and innovation to the world of delivery. With their bright colors and friendly design, 𝗟𝗡's robots are hard to miss as they quietly roll through neighborhoods, carrying everything from hot meals to groceries. Human drivers are the biggest cost for delivery apps. 𝗟𝗡's robots cut that expense dramatically. By replacing traditional couriers with autonomous robots, companies can save on wages, insurance, and other overhead, making each delivery far more affordable. This shift could fundamentally change the economics of food delivery, making it accessible to more people and profitable for more businesses. These small, friendly rovers are already delivering food in cities like Los Angeles, navigating sidewalks and crossing streets on their own. They're equipped to handle the hustle and bustle of urban life, weaving around pedestrians, waiting at crosswalks, and even responding to traffic signals. 𝗟𝗡's robots are designed to be approachable and safe, often drawing smiles and curiosity from passers-by as they go about their work. Born from Postmates and spun out after Uber's acquisition, 𝗟𝗡 knows the delivery business inside out. Their team brings years of experience in logistics, robotics, and on-demand delivery, giving them a unique edge in this rapidly evolving industry. The company's roots in two of the biggest names in delivery mean they understand both the challenges and the opportunities of getting goods to customers quickly and reliably. Their robots use cameras, GPS, and sensors to operate safely, with remote human oversight as backup. Advanced AI helps them detect obstacles, avoid hazards, and make real-time decisions. If a robot encounters a tricky situation, a human operator can step in remotely to guide it, ensuring every delivery arrives safely and on time. This blend of autonomy and human support is key to scaling up robot delivery in busy cities. The economics are compelling. After the initial investment, robots cost pennies to run, unlocking huge margin potential. With no need for breaks, tips, or overtime, robots can work around the clock, maximizing efficiency. For restaurants and retailers, this means lower delivery fees and higher profits, while customers benefit from faster, more reliable service. Uber Eats is a major partner and investor, with plans to deploy up to 2,000 𝗟𝗡 robots across the U.S., instant scale, and validation. This partnership gives 𝗟𝗡 immediate access to millions of potential customers and a steady stream of orders, accelerating their growth and cementing their place in the delivery ecosystem. 𝗟𝗡 plugs directly into Uber's order stream, skipping the need to build their own app or fight for market share. This seamless integration means 𝗟𝗡 can focus on what they do best: robotics and logistics, while Uber handles the customer experience and demand generation. The opportunity goes beyond food. Think groceries, prescriptions, and small parcels. 𝗟𝗡's robots are versatile, able to carry a variety of goods, and their secure compartments keep items safe until they reach the customer. As e-commerce and on-demand services grow, the potential applications for autonomous delivery are nearly limitless. The global last-mile delivery market is worth hundreds of billions. Every year, billions of packages and meals need to get from local businesses to customers' doors, and the demand is only increasing. 𝗟𝗡 is positioning itself to capture a significant share of this massive, fast-growing market. 𝗟𝗡 is a new public company. High risk, high volatility, but also ground floor potential. For investors, this means the chance to get in early on a company that could reshape how goods move through cities. but also the reality of big swings in stock price as the business scales up. If they execute with Uber and expand to other platforms, growth could be exponential. The more robots they deploy, the more data they collect, and the better their technology becomes. This creates a powerful feedback loop that could help Serve outpace competitors and dominate the market. Challenges remain: scaling manufacturing, navigating city regulations, and ensuring safety. Each city has its own rules for sidewalk robots, and Serve must work closely with local governments to gain approval. Building enough robots to meet demand while maintaining quality and reliability is another major hurdle. But rising labor costs and demand for on-demand delivery are strong tailwinds. As wages increase and more people turn to delivery for convenience, the case for automation becomes even stronger. Serve is well positioned to ride these trends and become a leader in the space. Serve can sell robots or offer robots as a service, creating recurring revenue as robot density grows. This flexible business model allows them to serve both large partners and smaller businesses, adapting to the needs of a diverse customer base. Their Uber partnership is a huge competitive edge, guaranteed demand that other startups lack. With Uber's backing, Serve can focus on scaling up and refining their technology, rather than scrambling for customers. Investing in Serve is a bet on automation as the future of urban logistics. As cities grow and delivery volumes surge, the need for efficient, scalable solutions will only intensify. Serve's robots could become as common as delivery vans are today. It's not about current profits, but about capturing a massive, fast-growing market. Early movers like Serve have the chance to set the standard for how goods are delivered in the future, shaping the industry for years to come. Watch how quickly they roll out those 2,000 robots and the feedback from real-world use. Customer satisfaction, reliability, and the ability to scale will be key indicators of Serve's long-term success. Serve Robotics is further up the risk curve, valued around $902.73 million with EPS at 1.05. Its 2024 revenue reached $1.81 million, while net income landed at $39.19 million, metrics that highlight aggressive growth spending as the company pursues adoption. Serve Robotics is a pure play on the future of delivery, massive market, clever tech, and a game-changing partnership. If they can overcome the challenges ahead, Serve could become a household name in urban logistics. Now let's shift from the streets to the hospital, where automation is also beginning to transform how critical supplies and medications are delivered within healthcare environments. 𝗗𝗟𝗏, ticker LFWD, is revolutionizing medical robotics for mobility and rehabilitation. This isn't just another medtech company, it's a pioneer at the intersection of robotics, healthcare, and human potential. By blending cutting-edge engineering with a deep understanding of patient needs, 𝗗𝗟𝗏 is setting new standards for what's possible in recovery and rehabilitation. Their flagship 𝗗𝗟𝗏 exoskeleton is a game-changer. It lets people with paralysis stand, walk, and even climb stairs, restoring not just movement but dignity, independence, and hope. For many, it's the first time in years they've been able to look someone in the eye while standing. The impact on daily life is profound, from being able to reach shelves to simply moving through the world on their own terms. The benefits go far beyond mobility. Standing upright reduces complications like pressure sores, urinary tract infections, and bone loss, issues that can lead to hospitalizations and long-term health problems. Improved circulation, better digestion, and even enhanced mental health are all linked to increased mobility. For patients, this means a higher quality of life, and for healthcare systems, it means lower costs and fewer preventable complications. 𝗗𝗟𝗏 recently acquired 𝗗𝗟𝗏, the company behind the innovative anti-gravity treadmills. These treadmills use air pressure to reduce a patient's effective body weight, making it possible to walk or run with less strain on joints and muscles. This technology is a breakthrough for anyone recovering from injury, surgery, or neurological conditions, allowing for earlier and safer rehabilitation. With 𝗗𝗟𝗏, 𝗗𝗟𝗏's reach now extends far beyond spinal injuries. They're helping athletes recover from sports injuries, supporting elderly patients to regain mobility, and assisting anyone who needs a gentler path back to movement. This dramatically expands their addressable market, positioning 𝗗𝗟𝗏 as a leader in multiple segments of the rehabilitation industry. Medical devices like these are not just high-tech, they're high-margin. Clinics and hospitals invest heavily in this equipment, and once they do, they rarely switch providers. The result is a loyal, sticky customer base that provides reliable, recurring revenue for years to come. 𝗗𝗟𝗏's business model is built for sustainability. Beyond the initial device sale, they earn recurring revenue from service contracts, maintenance, and consumable disposables. This creates a steady income stream and helps insulate the company from economic ups and downs. The biggest catalyst for growth is insurance reimbursement. Medicare now covers the 𝗗𝗏𝗏 exoskeleton for eligible users, opening up access for thousands who previously couldn't afford it. This is a game changer, unlocking a massive new market and making advanced rehabilitation accessible to more people than ever before. Every new insurance win is a powerful catalyst. Each approval not only drives more sales but also reduces financial risk for both patients and clinics. As more insurers come on board, the barriers to adoption fall, and LifeWard's solutions become the new standard of care. Despite all this progress, the stock remains beaten down, trading at a fraction of its potential. But with multiple products, a rapidly growing market, and a clear path to expanded reimbursement, LifeWard is positioned for a major turnaround. Investors are starting to take notice as the company's fundamentals improve. The synergy between ReWalk and 𝗗𝗟𝗓 is powerful. Clinics can now guide patients through every stage of recovery, from regaining basic movement to building strength and confidence. This integrated approach means better outcomes for patients and more value captured by LifeWard. Management has executed exceptionally well, especially with the strategic acquisition of 𝗗𝗟𝗓 and their relentless push for broader reimbursement. Their vision is clear, and their track record shows they can deliver. Of course, competition exists in the medical device space, but LifeWard's FDA-cleared products, robust clinical evidence, and established relationships with clinics give them a significant edge. Their technology is proven, and their reputation is growing. This is more than just a business. It's a bet on technology, transforming lives. LifeWard is helping people regain independence, improve their health, and reclaim their futures. It's a feel-good investment with real, tangible business potential. As the global population ages and the need for rehabilitation grows, demand for these solutions will only increase. More people will need help recovering from injuries, surgeries, and age-related conditions, making LifeWard's mission more important than ever. LifeWard, the smallest of the trio at a market cap near $18 million, posting EPS of $3.15 on 2024 revenue of $25.66 million and a net loss of $28.94 million. LifeWard's revenue is already on the rise, and with device sales ramping up, profitability is within reach. The company is scaling production, expanding its footprint, and building momentum for the next phase of growth. The problem they're tackling is enormous. Millions of people worldwide are affected by stroke, spinal cord injuries, and other mobility-limiting conditions. The associated healthcare costs are staggering, and the need for better solutions is urgent. Of course, there are risks. Reimbursement policies can change, competition is fierce, and the company may need additional capital to fuel its growth. These are real challenges, but they're balanced by the scale of the opportunity. If LifeWard continues to expand insurance coverage and drive adoption, the upside is compelling. The company is at the forefront of a movement that could redefine rehabilitation for millions. LifeWard is still in the early innings of a major transformation in how we approach recovery. The future of rehabilitation is being written right now, and LifeWard is holding the pen. So what's your next move? The opportunity is here, and the story is just beginning. There you have it. 3 robotics companies with game-changing potential: Robotics, Serve Robotics, and LifeWard. Each is a leader in its field with massive upside and real risks. Do your own research before investing. The robotics revolution is here, and these companies could define the next decade. Want exclusive stock tips and in-depth analysis? Join the Stocks Galore Patreon, link in the description. Now I want to hear from you. Which sector, autonomous cars, delivery, or medical robotics, has the most explosive growth potential? Drop your thoughts in the comments. Thanks for watching. Don't forget to like, comment, and subscribe. See you in the next video.